Hi. Good evening, everybody. I think we're going to start in a second. Just to say hello and thanks very much for coming along tonight. As you know, tonight Loren Goldner, standing here on my right, is going to be talking about fictitious capital and crisis, capitalist crisis. And as you may already know, Loren's been writing on this subject for some years now. He has a fairly distinctive take on capitalist crisis and has quite a lot to say about the contemporary conjuncture. As you probably couldn't fail to notice, there's a major financial crisis going on around us as we speak. So hopefully Loren will be addressing that as well as unpacking his analysis of fictitious capital. We'll get to the point pretty quickly, but basically Loren's going to speak for an hour or so, and then we'll take questions from the floor. And obviously look forward to hearing what everyone has to say on his presentation. So without further ado, I'll hand over to Loren, and hope you enjoy the talk. Thanks a lot. Thanks, Loren.
Okay. Is this thing amplified?
Don't stand too much to speak.
Sorry?
Don't stand too much.
Okay. Hi, I'm Loren Goldner, and I'd like to start out by thanking Mute Magazine for sponsoring this talk, and above all, I'd like to thank the world stock markets for creating some advanced publicity for the subject. As you undoubtedly know, the latest phase of the world credit crisis has been underway for the last, since about last August. And so I'm going to start out with some sort of current events, and then we'll work through a kind of history of how this crisis developed, and then get into what we might call the bedrock of Marxian theory of crisis, and I'm sure there'll be a lot of debate and controversy about that. One of the things that's quite striking for anyone who remembers the 1970s is parallels between the current situation and the situation of around 1973. In both situations, you have in the United States, and by the way, I want to quickly point out that if my analysis sounds America-centric, it's not just because I'm from America, but also because I do believe that this crisis is demonstrating again that the myths of decoupling of different parts of the world having become independent of the cycles of the U.S. economy right now is being revealed as a myth. What did you have in 1973? You had a crisis of the dollar. You had the old Breton Woods post-war monetary agreement unraveling for the final time. You had America bogged down in a losing war. You had a Republican administration sinking into oblivion amidst scandal and mismanagement, and a huge increase in the oil price that was these things were kind of all mixed together. Now, that can sound like an merely empirical or simply empiricist observation, and some of them are rather coincidental. But what I'm trying to emphasize is there is a kind of invariant quality to certain aspects of this crisis and previous crises, big and small, going back to World War II. It sounds like the sound. No, fine. Okay. So let me just try to unpack that. When many people are curious about my use of the term fictitious capital, and of course it is an expansion of the small chapter on fictitious capital that you find in volume 3 of Marx's Capital, but it certainly goes beyond that for the simple reason that capitalism itself in the development of credit markets through the 20th century has gone far beyond where it was when Marx was writing about the Bank of England playing the role of the last resort in capitalist financial crisis. Now, on the other hand, right now, the Bank of England and the Federal Reserve Bank and the European Central Bank are playing exactly that role of lender of last resort, but in a vastly transformed situation in which credit and financial, what some people call financialization, has come to occupy a much larger part of the overall functioning of capitalism. Capitalism has always had credit as a central part of its functioning. Even in reality, historically, the development of credit institutions really preceded the full development of capitalism itself. And systems of international loans, collapses of systems of international loans can be traced back to the 14th century, to the collapse of the House of Bardi in 1346, just before the Black Plague developed in Western Europe, and so on, right up to the actual emergence of capitalism in the early 19th century, when these the financial dimension is joined to what Marxists call value production, or labor power becoming a commodity, and actual capitalist development, and production being the main surplus that keeps the financial system going. So what has happened? What is new in today's situation? Sounds like there's some critics outside, but maybe they lost a bundle in the stock market today. But I would like to hasten to point out that I am certainly not an economist. If I'm interested in these matters, it's as the critique of political economy, the subtitle of Marx's Capital. But I have followed this stuff as a, shall we say, an educated layperson. The key new development that has emerged in the 1980s, 1990s, and since the meltdown, the dot-com meltdown, and the deep stock market downturn of 2000, 2002 is what capitalists and the bourgeois financial press calls securitized finance. And if there's one concept I would like to get across today in terms of how the credit system has evolved, that's it. Now, what is securitized finance? It takes many forms. If you try to read the financial pages today, you're overwhelmed by various abbreviations, CLOs, CDOs, SIVs, sovereign wealth funds, and so on. Securitized finance means taking a certain cash flow and turning that cash flow itself into an asset that is sold to somebody else, which in turn generates a cash flow, and in some sense creates an almost infinite possibility for the creation of credit. One of the things that is striking about today's situation is how little power the central banks really have in managing what is going on. The last time I looked, the Federal Reserve Bank of the US had about $74 billion in assets to play around with in influencing currency flows and so on. A drop in the bucket in a world economy where $1 trillion a day exchange hands on world financial markets. And I'm sure similar ratios apply to the other major central banks as against all the assets out there. So securitized finance means I'm a banker, I make 100 mortgages, I package them into another kind of asset. They're providing an income stream and the payment of the mortgage, and I sell that asset to somebody else who is now dependent on the solvency of the people holding those, paying off those mortgages. And they can turn around, make a package of 100 such bunches of 100 mortgages and sell that as an asset. And they have different names. I don't even begin to understand how they all interact. As a matter of fact, most CEOs today don't understand how capitalist financial markets work. It's not an accident that on Wall Street and in the City of London, in the banking, in the planning departments of banks, you find astrophysicists and mathematicians developing computer models that only they understand, and they have to explain to the CEOs how these different forms of securitized finance interact with each other. But what it comes down to is what we can call a pyramiding of credit. And that pyramiding of credit, of course, is imploding right now, as anyone familiar with 200 or 300 years of capital history could predict. Now, why is this fictitious capital? Fictitious capital, as I use it, simply means claims on, capitalist claims on the total surplus produced in production itself, as well as other unpaid sort of free lunches that come into the system through what I call primitive accumulation, both in the narrow sense as it was used, as it has been used in the Marxian tradition, as well as some other less orthodox uses of the term in different polemics, including those generated by the Mute article of last summer. I've said if primitive accumulation is not the adequate term to describe the looting of nature, the destruction of nature, the free lunch that capitalism takes from nature, or the driving of the living standard of workers in the heart of capitalism below the reproductive level, then let's find another term. But it's important against sort of mainstream Marxist orthodoxy to recognize that that is going on. So let's just very quickly look. I've just drawn the simplest possible sketch of Marx's basic concepts of Department 1 and Department 2. Most of you are familiar with them, but let's just run through it quickly. Department 1, of course, being production of means of production, the machinery, tools, equipment that capitalists use to produce. And this bar, of course, divided into constant capital, the actual machinery and other equipment, variable capital, the total wages of the working class, and S, surplus value, the surplus value generated in the production process. Over here we have Department 2, production of means of consumption. And this is a more complicated part because, of course, the two departments interact, and workers who are producing means of production are obviously not consuming steel or machinery. They're consuming goods coming from Department 2. And most importantly of all, for the current situation is what I broadly term capitalist consumption. Now, that is not merely the consumption of the capitalists themselves, but of a large group in society that we can call capitalist house servants, people who consume surplus value and do not produce it. And I can't break that down statistically, but certainly in the American economy, this population is probably half of the active population workforce. Now, who are these people? First and foremost, I would put the so-called FIRE category: finance, insurance, real estate. That part will be shrinking fairly quickly as the year proceeds. According to the Financial Times the other day, 200,000 people around the world have already been laid off from banking jobs, and particularly in the mortgage department. A very substantial sector. I also include in that bureaucracy, both civil service and corporate bureaucracy, various levels of managers of different kinds. The military population, the U.S. economy ever since World War II has had a ballooning military sector. It got smaller in the course of the 90s after the end of the Cold War, but has grown again to elephant-sized proportions since 9/11. And finally, law enforcement, prison personnel, and so on. A very large part of the total capitalist workforce. Now, I'm sure some people will have some questions about who to include in that category, but as I say, I submit that it's a very large part of the current population in the so-called advanced capitalist world. Now let's get back to fictitious capital. Capitalists do not experience capital as value. They certainly do not experience it as what Marxists call constant capital. They experience it as different instruments that are capitalized claims on future flows of income. Let's take a simple example. Well, let's take the simplest example of all. A bond, theoretically, worth $100. In a general environment in which the rate of profit available to capitalists across the board is 5%, if the rate of profit fell to, say, 2%, the value of that bond would grow as a capitalization with a 5% income flow larger than the general rate of profit. If the general rate of profit rose to 10%, the value of that bond would fall because it would be lower than the generally available rate of profit. That's the core concept of capitalization. Essentially a multiple of an income stream. Let's take a slightly more complicated example, a real estate investment in a tenement in the Bronx in New York City. The building was built 100 years ago. It's decaying. It's sold, resold. Tax write-offs are claimed on it. But nevertheless, filled with renters, it produces a substantial income stream for the owner that has effectively nothing to do with the cost of actually building that building or replacing that building. And this is something I would really want to emphasize, that over a long period of time in capitalist cycles, these total capitalized assets, the ones that we're seeing implode right now, can grow way out of proportion to the surplus that is generated in the system by the processes described in volumes 1 and most of volumes 2 of Capital. So how are these, what makes them fictitious is precisely this gap between the total claims on wealth of all the capitalist class versus the wealth that is available. How is that gap closed? Closed by the different forms of primitive accumulation that I referred to earlier. Incorporation of labor power out of petty producer populations from around the world. In the 19th century, in the heyday of capitalism, those populations were the peasants of Western Europe, the farmers of the United States, artisans and other small producers who were proletarianized into the wage labor workforce. Today, capitalism recruits them out of the countryside of Africa, Asia, Latin America. For example, recently with NAFTA, the free trade agreement between Canada, the US, and Mexico, part of NAFTA was the dismantling of the old ejido, the sort of collective farms that grew out of the Mexican Revolution, pushing millions of Mexican rural laborers into the cities and on into the United States, where today they constitute this newly recruited workforce whose costs of reproduction the capitalist class did not have to pay for. These are just examples of ways in which the capitalists can move social reproduction, socially reproduced wealth into the category of surplus to maintain the total capitalization, the total credit structure that they create. I'd just like to emphasize that one rock bottom aspect of capitalism is its anarchic quality. We can see this right now in the way in which one big part of the crisis that started last summer is that almost nobody really knows how serious it is. The assets that are circulating around that used to be freely traded, used as collateral for further loans, nobody can tell what they're worth because they might be 5 times removed from the actual income stream, say, of American mortgages. So that's just a simple contemporary illustration of what I mean by the anarchy of the system. But the deeper anarchy of the system is simply the division of production into a myriad of enterprises. Amadeo Bordiga, the Italian Marxist theorist, used to say the hell of capitalism is the enterprise, not simply the fact that the enterprise has a boss. That scattering of production into a whole series of units competing with each other so that no one really has a full view of the system. No capitalist can possibly think in these terms. No capitalist can possibly understand what Marx calls the total social capital at the end of Volume 2. They're simply, they're acting in a hall of mirrors in which it's very difficult for them to truly grasp the dynamic of the situation. Okay, so that's broadly speaking what I mean by fictitious capital. Now, how did the world get to this situation? Let me just go back into a little history. And I won't go back any farther than World War II. Don't want to wear everybody out. But as many of you know, at the end of World War II, the United States emerged as the overwhelming victor of the war. It was nominally allied with Great Britain, but in fact, one of the main outcomes of the war was the fleecing of Great Britain of its financial assets as well as its empire. And so one might say that with allies like that, you know, who needs enemies? But the upshot of the American victory was the creation of what was called the Bretton Woods system. The Bretton Woods system, without getting into technical details, was a system of fixed exchange rates between all the major capitalist countries, most of which, of course, were being rebuilt with American loans and American aid. And the whole system was centered on the dollar. The dollar and gold together were considered to be what are, in technical terms, are called international reserve assets. The dollar is still today the international reserve currency, though it's now being challenged by the euro. Now, what does that mean? Just very simply, it means that as capitalist production develops, international trade develops, and we can imagine at the end of the year, of a year of production, the different countries are exchanging either gold or dollars to cover deficits and as a stored form of surpluses. Imagine it as a poker game in which people are settling up after every hand. Now, for 15 years after World War II, this system worked rather well. It worked well, particularly for the United States, because the dollar was valued against the pound, the French franc, the German mark, the Japanese yen at very high levels. And so already built into the Bretton Woods system was what you might call a kind of rent or imperial tribute that went to the United States through the mechanisms of ordinary trade. Germans sent cars to the United States. The French sent wine and whatever else they were sending, and so on. And in return, they got these dollars. Now, in the 50s, those dollars were very useful for continuing post-war reconstruction and actually developing industry that was more competitive than the United States. But around 1958, this system ran into trouble for the first time, began to sputter. And as a signal of that, I believe it was in 1960, suddenly the price of gold shot up from the fixed $34 an ounce to $40 an ounce, which was considered a catastrophe at that time. Just think of it today when the price of gold is hovering between $850 and $900 an ounce. In the Bretton Woods system, the dollar was known as paper gold. The system went through a series of crises. Various piecemeal patchwork solutions were found through the 1960s, but the situation persisted. And the real crux of the matter, which we can see again today, was that inflation was taking off in the United States, and people holding those dollars abroad were saying, well, we're getting 2% on some bond that we're invested in, and particularly in the U.S. financial markets, U.S. government paper paying a certain general rate of interest. And at the same time, inflation in the United States is 4, 5, 6% and increasing. So while we're sitting here with these assets, they're being depreciated simply by American inflation. That's exactly what's going on today on a much larger scale. China, in particular, holds, I think, certainly over $2 trillion in the Bank of China. Other Asian banks hold another trillion. The Arab oil exporters, I'm not sure how much, but they're all undergoing this very same problem on a much larger scale that was already visible in the 1950s. Finally, in 1971, 73, this system cracked. And a series of international conferences were held, and Richard Nixon, then President of the United States, announced in the spring of 1973 the greatest monetary treaty of all times, one which collapsed about 6 months later. And from that time on, this relationship, fixed exchange rates, and a relationship between fixed relation between gold and the dollar was gone. Michael Hudson, who's a very interesting non-Marxist economist who wrote a great book called Super Imperialism, which I strongly recommend to anyone who wants to look into this, said in 1973 the world went from a system of paper gold to a system of paper, meaning that from that point on, anybody who was trading with the United States and running a surplus was building up more of this monopoly money in their central banks in exchange for real goods. Now, what this means concretely is that the United States holds a very powerful tool in imposing its general economic program, the so-called Washington Consensus of the last 15 or 20 years on everybody else. Because it comes down to a simple principle. If I owe you $1,000, I'm in trouble. But if I owe you $1 million, you're in trouble. You have to keep me solvent and liquid. And therefore, the basic dynamic has been, from a very small start in the late 50s to a gargantuan scale today, the recycling of those dollars into American government paper, primarily treasury bills and other kinds of bonds, as well as the US stock market and financial markets, with the net result that it allows further credit expansion in the United States. So what we've seen in this series of bubbles that we're familiar with from the last 10 or 15 years, first the high-tech bubble, more recently the housing bubble, and general asset bubbles, the unbelievable rise of commercial real estate and things of that kind, is a situation in which the rest of the world is constantly subsidizing the general economic stagnation and decline of the United States. And I should emphasize that this whole process of financialization, this whole process of credit expansion and recycling of dollars back into US financial markets has accompanied and has accelerated the outsourcing of most American production to the rest of the world. So that consumer debt in the United States has now risen to something like 15 or 20% of average incomes. Since 2000, 2001, the housing bubble has been treated by many Americans as an ATM. I buy a house for $200,000 in 1995. By 2005, it's worth $600,000. I get a second mortgage against that amount, and I spend that money on luxury consumer goods. Well, what's the problem? Housing prices always rise, and then lo and behold, housing prices go into reverse, and all kinds of people are underwater, holding mortgages that are far in excess of the current real value of their houses. As one very striking example that's well known today as the subprime crisis. So that's the basic story on the side of credit. It's really striking that with 20 years of hype about the information economy, the knowledge economy, and various other terms, that what it really comes down to in America is housing and the sale of cars as the two most important markers of the health of the economy. So that underneath the rise of the so-called BRICS, Brazil, Russia, India, China, I'll get to that shortly, behind the year in, year out rise of phony figures like GDP, what has actually gone on has been a general erosion of anything we can call real wealth in the US economy, which increasingly comes from abroad. They produce, we consume. And most recently, of course, Asia and China above all as the new capitalist workshop of the world. Now, it's been said for years that this is unsustainable. Some clever neo-Keynesians 10 or 15 years ago came up with this idea of Bretton Woods 2. That is, okay, it's true, the gold is gone, but with the dollar as the international reserve currency, this process is sustainable. And it just sort of seems mad, that I can go deeper and deeper in debt so I can buy things from you, and that's a sustainable process. And we're seeing the end of any illusions of that kind right now. Okay, just very briefly, let me touch on the crises that have unfolded under this regime, to use a certain term. 1973-75, the deepest downturn after World War II, until the downturn of 1980-82. 1989-91, these were all called recessions, and by certain criteria, certainly by comparison with 1929, they were recessions. Another short downward blip in 2000, 2002, connected to 9/11 and also to the end of the dot-com phase. And now, and in the last 6 years, a new expanded bubble, or different bubbles, but most importantly, the housing bubble. So the capitalists never are short, or never seem to be short of rabbits to be pulled out of a hat to keep this process going somehow. But nevertheless, we know, looking at it from a very different point of view, that the material reproduction process, so to speak, underneath all this, the actual real consumption of workers and even of these capitalist consumers, the fire sector and so on, has to go on, has to support all these claims on wealth that are circulating in paper form. Okay, that's the economic picture. But we also know the critique of political economy means there is no economics in itself. There's also politics, geopolitics, and ultimately the force of the state, that is the military dimension of capitalism. One of the reasons that I emphasize the permanence of primitive accumulation in the capitalist system is to emphasize the way in which the initial violence with which the wage labor force was created, 15th through the 17th century, stays with the system in some form or another, receding at times, such as in the post-war boom from 45 to 73, coming to the fore again in the reorganization of capital since that phase accumulation ended. And geopolitics is a central part of this. Now, there's a lot of talk, many books are written, much is found in the newspapers about the movement of the center of empire west to Asia and the rise of China, and more recently, India, as well as the smaller tigers which first emerged in the 1970s and 1980s. I frankly find that overall, the way it's sort of taken for granted to be highly problematic. Because just as in the same way as the US replaced Britain as the kind of arbiter of world capitalism through 2 world wars, I cannot imagine Asia rising and displacing the United States without some comparable violence and confrontation. And therefore, in the same way that the key economic relationship in the world today is between American consumption and Asian production, and above all, Chinese production, we can see that kind of a confrontation shaping up. I'd just like to do a short aside on that. You're familiar with the history of the Great Game in the 19th century, the rivalry between England and Russia to control the perimeters of Russia and China. And as everybody generally recognizes by now, there's a new great game going on with the Americans trying with an overall strategy to control that whole perimeter from the Baltics to Korea and Japan. I'd say that one aspect of the Iraq War was, in addition to getting Halliburton and Bechtel and other companies like that, getting them big cost-plus contracts, the oil companies, American oil companies, getting their hands on Iraqi oil. that it was a geopolitical move ultimately aimed at the military encirclement of China. And this was pretty consciously recognized in the year or two after 9/11, when Putin and the Russian government allowed American military installations in several of the ex-Soviet Central Asian republics, when and the Chinese government said openly, hey, Putin, what are you doing? The Americans are trying to encircle us, and here you are letting them. And not only that, but of course, getting a hold of the sources of world oil as a way of putting the screws on China in some future confrontation. Now, it's well known that China is scrambling all over Africa right now, particularly to oil-rich countries like Angola. It's just hilarious to read in the New York Times, Wall Street Journal, Financial Times, Western capitalists warning China not to exploit Africa's material resources and raw materials, as if they weren't doing it for 500 years. A real boom has taken off in many parts of Latin America, Brazil above all, as well as in some of these contested parts of Africa. But that boom is all essentially raw materials going towards China and then being shipped to the United States as finished products in exchange for these little green pieces of paper. And as America implodes, that whole process comes to an end. Therefore, without wanting to make any predictions, I think that we have to see that this is not merely an economic crisis, just as no major capitalist crisis in the past has been a merely economic crisis, but that there can be, and I think will be, a conscious military dimension to it, that we shouldn't just think of a capitalist crisis as something that happens, oh my God, the stock market is falling. There's always some faction of people who want to use that crisis, whether it's J.P. Morgan watering stocks in the 1890s and then benefiting from the crash to buy up everything at bargain basement prices, or some faction today that will want to actually transform what appears as an economic implosion into a social and political crisis to impose some kind of agenda that, as I'm sure we can all agree, won't be pretty. Now, in terms of working class politics and the kinds of politics that we are interested in, if we look at the broad history of the 20th century and up till today, we notice that as the old British imperial system began to wobble through World War I, an opening was created in the aftermath of World War I in which the most extensive proletarian upsurge in history took place. The Russian Revolution, failed revolutions in Germany, Italy, near revolutionary crisis in Britain in January 1919, mass strikes in the United States, and essentially everywhere in the world, something on that order taking place. And optimistically, I think we can foresee an opening of a similar kind happening through this crisis as American power starts to really wobble, which it already has, but at a slightly later date. So, from a practical point of view, not to merely view this as an interesting problem to analyze, it's imperative to think about it in sort of programmatic terms of preparing for that kind of a situation and pushing a revolutionary movement forward with whatever tools we can bring to bear. I'm sure there will be people who want to bring that up in the discussion. Now, I'm leaving out a number of things, but above all, I'm leaving out the core analysis of the structure of Marx's 3 volumes of Capital that, in my opinion, underpin this analysis. As I said, many of the things that I've been talking about are developments of capitalist credit markets since Marx's time. I call your attention to, if you haven't already looked at them, the very interesting geopolitical writings of Marx and Engels through their whole collaboration. Engels, for example, wrote a very interesting article in 1860 on Afghanistan in which he said, because of his interest in military science, that no Western power should ever go in there because they're going to get their asses kicked. To put it very so. Marx and Engels, of course, were looking at the decline of the Ottoman Empire. They were concerned about the huge influence of Tsarist Russia in European politics, and so on, and were trying to align their conception of working class, the task of communists as the unification of the working class in that overall geopolitical analysis. And I think by looking at things like the new American Great Game on the Eurasian landmass, we can start to situate local and national and regional struggles in a similar framework. So I see